The greatest profit is not made by trading the daily noise, it is made by accurately identifying the major cycle and sitting still. Most traders are obsessed with daily price fluctuations, missing the grand drama unfolding over years. Livermore realized that the market moves in predictable cycles of boom, panic, and recovery, a rhythm dictated by human nature itself. Greed and fear do not change, they simply repeat the same patterns. Decade after decade, the amateur is always reacting to the news. The professional is anticipating the next phase of the cycle. Livermore's secret to decoding the big picture was not complex economics, it was the simple yet profound observation that history repeats itself on the chart. Mastering the big picture means understanding that you cannot fight the major cycle, you must simply position yourself ahead of it. This foresight begins by mastering the true definition of a major move. Never mistake a rally in a bear market for a new bull market. The trend is your friend until it bends, and you must recognize the bend. Livermore spent years analyzing market history to distinguish minor fluctuations from the major trend. He defined the major trend not by time, but by its structural integrity. A true bull market is defined by successive higher high pivots and higher low reactions. A true bear market is the opposite, successive lower low pivots and lower high rallies. The mistake many traders make is confusing a natural reaction within the cycle, a temporary pullback, with a genuine trend reversal. Trading the big picture means ignoring the intraday noise and focusing solely on the significant weekly and monthly pivotal points that confirm the cycle's direction. What time frame do you use to define the major trend? Daily, weekly, or monthly? Comment your preference. The cycle is not about price alone, it is fundamentally about the flow of money and the psychology of crowds. Cycles are not economic events. They are predictable manifestations of human greed, leading to panic. Livermore recognized that market cycles are fundamentally psychological cycles. The boom phase is driven by intoxicating greed, where everyone believes prices will only go up, leading to overspeculation and reckless debt. The panic phase is the mirror image and emotional collapse, driven by fear, where rational thought vanishes and everything is sold regardless of value. The key to trading cycles is to position yourself before the psychology becomes extreme. You must buy when everyone is cautious at the end of a panic, and sell or short when everyone is wildly enthusiastic at the height of the boom. He used his charts to spot the point where rationality ended and mass emotion began. The critical tool for spotting the cyclical peak is observing distribution phases in major sectors. The big money does not exit in one moment, it quietly distributes over months while the public is still celebrating. The secret to profiting from the transition from boom to panic is identifying the distribution phase. Livermore knew that the major pools of money do not suddenly dump their entire holdings. Instead, they begin to quietly sell their shares over several months at ever higher prices, while the general public is still buying the headlines. This distribution phase is marked by high volume but very little further price advance, a lack of follow-through when the market fails to make a decisive new high despite enthusiastic news and volume. The major cycle is topping out. The ultimate signal is when the big market leaders fail to follow the secondary stocks higher. Once the distribution is complete, the true bear phase begins, and Livermore's discipline changes entirely. The true professional makes money on the way up and the way down, but the big money is often made in the panic speed. Once the distribution phase is confirmed by a decisive break below a -1 pivotal point, the speculator must position for the panic. Livermore was a master of short selling. His approach during the bear cycle was based on the fact that panic moves faster than booms because fear is a stronger emotion than greed. He would use his pivotal point strategy to initiate short positions when stocks broke key support levels. He understood that during a panic, bad news is amplified and stop losses are triggered en masse, accelerating the decline. This requires the psychological readiness to be bearish when the majority of the world is desperately hoping for a rebound. Do you actively short sell, or do you only trade the long side? Comment your strategy. The greatest psychological challenge during the panic is managing the short-term rallies. Never mistake a market's gasp for a market's recovery. The bounce is simply a refueling stop for the next decline. During a bear cycle, the market experiences sharp, violent upward bounces, known as bear market rallies. The amateur sees these as a new bottom and buys back in, only to be crushed when the decline resumes. Livermore viewed these rallies with extreme skepticism. He recognized that these are temporary technical corrections caused by short covering and desperate buying, not fundamental change. The discipline is to use these rallies as opportunities to initiate or add to short positions, not to go long. The fundamental structure of lower lows and lower highs remains intact until a major reversal pivot is confirmed. The true end of the panic is signaled not by price, but by the extreme emotional state of the public. The final bottom is not a price, it is a psychological event where the public sells everything in exhausted despair. Livermore knew that the true market bottom is confirmed not by the news or an arbitrary low price, but by psychological capitulation. This is the point where the general public has sold everything they own due to emotional exhaustion and utter despair. There are no buyers left, because everyone who wanted to sell has sold. This capitulation often manifests as a final high-volume selling climax, followed by a dead silence in trading activity. When the news is universally bleak and the emotional landscape is one of absolute surrender, that is the time to start looking for long opportunities using the pivotal point entry. The reversal of the cycle from panic to recovery is slow and requires immense patience. Buy when the market is universally hated and your risk is clearly defined. Do not buy when the headline is positive. The move from panic to recovery is marked by the accumulation phase. Just as distribution was a quiet selling period, accumulation is a quiet buying period. The smart money begins to buy up quality stocks cheaply while the market is still skeptical and the public is avoiding the market entirely. This phase is characterized by price stability with increased volume on upward moves and decreased volume on downward moves. Livermore would begin initiating his long positions using his test entry protocol only after the first -1 pivotal point broke the last significant swing high, confirming that the buyers had wrestled control from the sellers. What is the hardest part about buying a bottom? The fear of buying too early or the psychological despair? Comment your biggest struggle. The key to cycle trading is the relentless comparison of present action to historical precedent.